For decades, California carried the myth that home prices could only move in one direction: up, golden beaches, booming tech hubs, sprawling suburbs. Owning a house here was supposed to be a guaranteed ticket to wealth. But in 2025, that story is being rewritten. The California dream of real estate riches is colliding with reality, as prices in some cities are sliding faster than anyone expected. Behind every percentage drop, there are families discovering that the roof over their heads has turned into a financial trap. Once coveted neighborhoods are now dotted with for sale signs, empty condos, and frustrated owners watching their equity evaporate. In this video, we'll count down the 10 California cities where values are falling the fastest right now. This isn't just a list of numbers, it's a portrait of how jobs, lifestyle shifts, and hidden costs are reshaping the market. Maybe you live in one of these places, maybe you've thought about investing here. Either way, staying informed could save you hundreds of thousands of dollars. So stick with me until the end, because the city at number 1 is not just surprising, it's a symbol of how fragile California's housing market has become. Let's start our list in Vallejo, a waterfront city just north of San Francisco that once attracted commuters with cheaper homes and a ferry ride into the bay. A few years ago, Vallejo was pitched as the affordable gateway to the Bay Area. Families moved in, investors scooped up rentals, and for a while it looked like Vallejo had finally shed its rough around the edges reputation. But in 2025, that shine is fading. Median home values that pushed near $500,000 during the pandemic boom have been retreating sharply. In many neighborhoods, houses are now listed well under $350,000. That may sound like a bargain compared to San Francisco prices, but here's the catch. Buyers aren't exactly lining up. Days on market have doubled, and realtors whisper about deals falling through at the last minute. Part of the problem? Hidden costs. Vallejo's property taxes and utility bills have climbed steadily, and water bills here are notorious. Some families report paying nearly as much for water as for their monthly car payment. Insurance hasn't been kind either. With climate risks and insurers tightening their belts, premiums have gone up, even as home values have gone down. And then there's perception. For years, Vallejo has battled a reputation for crime and underfunded schools. While the city has made progress, that stigma still scares off many buyers. Imagine walking into an open house and seeing not one but 3 price-reduced stickers slapped on the listing. It doesn't exactly scream confidence. Now, does that mean Vallejo is doomed forever? Not necessarily, but here's the question. Would you gamble your savings here right now when other nearby markets are stabilizing faster? Drop a comment if you'd take the risk or if Vallejo is already off your list. Coming in at number 9, we head to Fresno, the heart of California's Central Valley. For years, Fresno sold itself as the place where families priced out of coastal cities could finally afford that classic American dream. A big yard, a garage for the kids' bikes, and maybe even a swimming pool to survive those 100-degree summers. But in 2025, the dream is cracking. Home values that climbed above $400,000 during the pandemic frenzy are sliding back toward the low $300,000. And while that might look attractive on paper, it's the other bills that have Fresno homeowners sweating more than the summer Sunday. Insurance companies have been reassessing wildfire and flood risks across the valley, and many policies are suddenly much more expensive or harder to get. Picture this. You finally close on a house, and just weeks later, your insurer sends a letter saying they're pulling out of the area. Now you're scrambling to find coverage that costs twice as much and sometimes with less protection. Not exactly the housewarming party you imagined. The rental market tells its own story. Landlords who once bragged about double-digit rent hikes are now quietly lowering asking prices. One local property manager joked that it feels like musical chairs with empty seats, too many units chasing too few qualified tenants. And when rents soften, investors get nervous, which only adds pressure on home prices. Fresno also has a jobs puzzle. Agriculture has always been the backbone here, but tech and professional sectors never materialize the way boosters promised. With remote workers drifting back toward bigger cities, Fresno is left asking, who's going to fill all these homes? So here's the interactive moment for you. If you had $300,000 in cash to spend, would you rather roll the dice on Fresno or head out of state where insurance isn't a nightmare and jobs are more diverse? Let me know in the comments, because Fresno's future really depends on whether buyers still see it as affordable California or just another market caught in the crash. Number 8 takes us down to Riverside, a city that once wore the crown of Southern California's affordable alternative. For years, families who couldn't afford Los Angeles or Orange County packed up and moved inland, trading a 2-bedroom condo near the beach for a full suburban home with a backyard and maybe even a pool. But that trade-off looks a lot less appealing in 2025. During the boom, Riverside's median home price shot past $550,000. Today, many listings are hovering closer to the low $400,000, and in some neighborhoods dipping under. That's a 6-figure swing in just a few years, and it's leaving a lot of homeowners wondering how much equity they really have left. And then there's the commute factor. With gas hovering around $5 a gallon and traffic worse than ever, that daily grind into Los Angeles is no longer just tiring, it's financially punishing. Remote work once made Riverside shine, but as companies call employees back to the office, suddenly those long drives are back on the calendar. The rental side isn't helping either. Rents that soared past $2,400 a month in 2022 are now sliding back toward $1,900. That may sound like a win for tenants, but for investors who bought at peak prices expecting steady growth, it's a harsh reminder that markets don't always go in one direction. Add in the rising cost of insurance, and Riverside homeowners are juggling monthly expenses that feel more like a mortgage stacked on top of another mortgage. Imagine buying your forever home only to discover that between property tax, HOA fees, and car fuel, you're paying more to stay put than you ever did to move around. So here's my question for you. Would you still choose Riverside if it meant saving a little on housing but spending a fortune on everything else? Comment below, because for many families, Riverside's affordable escape has turned into a very expensive compromise. At number 7, we land in Bakersfield, the oil and agriculture hub that for decades carried the badge of California's last affordable city. For a long time, that reputation pulled in families fleeing sky-high prices in Los Angeles or San Diego. You could buy a 3-bedroom house here for what felt like pocket change compared to the coast and still have money left over for a truck in the driveway. But 2025 is telling a different story. Home values that peaked near $400,000 during the pandemic are now hovering closer to the mid-$260,000s. That's a dramatic drop, not just in numbers, but in confidence. When people see values fall by more than a third, they stop asking, when should we buy, and start asking, should we leave? Energy jobs, once Bakersfield's safety net, have also been under pressure. With California pushing hard toward renewables, the oil sector that built this city is shrinking. That means fewer stable paychecks to support the housing market. At the same time, agriculture is struggling with persistent water restrictions, which adds another layer of uncertainty for workers and investors alike. Then there are the monthly costs that catch new buyers off guard. HOA dues in newer developments run higher than expected, flood insurance is increasingly required near the Kern River, and water penalties can hit hard during drought years. Suddenly, that cheap house doesn't feel so cheap once all the bills are stacked up on the kitchen counter. It's not all doom and gloom. Bakersfield still offers a lower cost of living compared to much of California. But here's the catch. Affordability doesn't matter if the investment itself is sinking. Imagine watching your neighbor's house, the one nearly identical to yours, sit on the market for months with price-reduced signs slapped over and over. That's the reality locals are seeing right now. So I want to ask you, if you were priced out of Los Angeles, would you see Bakersfield as a lifeline, or would you treat it as a risky detour? Share your take, because Bakersfield's role in the California housing story is more uncertain than ever. Sliding into number 6, we arrive in Stockton, a city that has long been the poster child for California's housing ups and downs. Remember, Stockton was one of the hardest hit places during the 2008 foreclosure crisis, and for a while it carried the stigma of bankruptcy and abandoned subdivisions. Then came the pandemic boom, when home values roared back and optimism returned. But in 2025, the cycle seems to be repeating itself. Median prices that once brushed $450,000 are now struggling to stay above $300,000. That's more than a third of the value wiped out in just a few years. For families who bought near the peak, it's like watching their savings dissolve with every Zillow update. And Stockton has another challenge: perception. When a city gets branded as a foreclosure capital, that label sticks. Even as some neighborhoods have improved with new schools and retail, investors hesitate. One realtor I spoke with said bluntly, "People ask if Stockton is safe to invest in, they don't ask what the house looks like. That kind of doubt depresses demand before buyers even step through the door. Everyday costs aren't helping either. Utility bills in San Joaquin County are infamous. Some households pay $250, $300 per month just for water. Add that to rising property taxes and insurance premiums, and the so-called affordability gap between Stockton and the Bay Area isn't as wide as it once looked. Drive around today and you'll spot a telling scene: boarded up windows on stalled flip projects, for sale signs sitting crooked in unkempt lawns, and neighbors whispering about who's giving the bank back their keys. It's deja vu, and not in a good way. So here's a question for you. If Stockton is dropping fast again, does that make it a bargain waiting to be seized, or a trap that will pull buyers underwater? Comment below with your thoughts, because Stockton's story may just foreshadow what happens next across California. At number 5, we land in Ventura, a coastal city often seen as the calmer, more affordable neighbor to Santa Barbara. For years, Ventura's draw was obvious: ocean breezes, a surf culture that felt authentic rather than touristy, and homes that cost less than Malibu but still delivered the California beach town lifestyle. But in 2025, Ventura's market has lost some of its shine. Home values that peaked near $700,000 have slid noticeably, and while the exact percentage varies by neighborhood, the mood is unmistakable. Sellers are nervous and buyers are hesitant. The slowdown isn't just about price, it's about the true cost of living here. Insurance premiums have surged, with many homeowners now paying $5,000, $6,000 annually just to protect their property. Why? Because Ventura County faces a cocktail of risks: wildfires inland, flooding in low-lying coastal zones, and landslides after heavy rains. For some buyers, those bills are deal breakers. Add on California's already hefty property taxes, and suddenly a modest beach cottage feels like a financial anchor. Remote work once made Ventura glow. Young professionals could surf in the morning and log on to Zoom by noon. But as companies tighten return-to-office policies, many of those workers are reconsidering whether the commute to Los Angeles, often more than an hour with traffic, is worth it. Without that steady stream of remote transplants, demand has softened. The local rental market reflects the shift. Units that once commanded premium rents are sitting longer on the market, with landlords quietly trimming prices. That undercuts investor confidence and pressures resale values further. Still, Ventura isn't falling off the map. The beaches are beautiful, the vibe is laid back, and for the right buyer, prices today might look like tomorrow's bargain. But here's the dilemma. Are you willing to pay thousands each year in insurance just to live by the ocean, knowing values may keep sliding? Let me know in the comments, would you trade financial certainty for a seaside lifestyle, or is Ventura just too risky in 2025? At number 4, we head a little further down the coast to Oxnard, another beach city that once promised oceanfront living without Malibu's millionaire price tag. Oxnard was marketed as the undiscovered gem of Southern California. Quieter beaches, a working harbor, and neighborhoods that felt more down to earth. For a while, it worked. Buyers who wanted that surf and sand lifestyle but couldn't stretch into Santa Monica or Ventura saw Oxnard as their answer. But in 2025, that promise is under serious strain. Home values that soared above $800,000 during the pandemic have now pulled back sharply, dipping closer to the $540,000 range in many cases. Condos and townhomes near the marina, once listed for well over $1 million, are now sitting stale on the market with price-reduced banners flashing like neon. The problem is twofold. First, ownership costs are skyrocketing. Flood insurance in Oxnard has become notorious, with annual premiums in some low-lying zones reaching $4,000 or more. Add HOA fees that can climb over $1,200 a month in waterfront complexes, and suddenly, the affordable coastal dream feels more like a monthly financial squeeze. Buyers don't just look at listing prices anymore, they calculate the never-ending bills that follow. Second, the job dynamic isn't helping. Oxnard doesn't have the robust employment base of Los Angeles or Silicon Valley, and many residents rely on commuting. But with remote work dialing back, people are asking themselves if long commutes and sky-high carrying costs are really worth the ocean view. Drive through certain neighborhoods today, and you'll see the signs of stress. Half-renovated properties stalled mid-project for sale signs fading in the sun, and local forums buzzing with complaints about HOA boards raising fees again. Investors who once rushed in are pulling back, leaving sellers in limbo. So here's my question for you. Would you pay luxury-level costs in a market where values are slipping, or would you look inland for stability? Drop your answer in the comments. Because Oxnard's story is a test case for how fragile California's coastal housing dream really island. At number 3, we head to Sacramento, California's capital city. For years, Sacramento was pitched as the best of both worlds, close enough to San Francisco and Silicon Valley for jobs, but far more affordable when it came to buying a home. Families moved in droves during the pandemic, drawn by bigger houses, backyards, and the promise of a calmer suburban life. But in 2025, Sacramento is feeling the hangover from that boom. Home values that once surged past $500,000 are now drifting downward, with some neighborhoods seeing drops of 20 to 30%. Sellers who expected bidding wars are discovering a harsher reality. Multiple price cuts, longer days on market, and buyers who simply walk away rather than stretch their budgets. The shift is amplified by Sacramento's dependence on commuting. Gas prices hovering near $5 a gallon make that reasonable drive to the Bay Area anything but. And with many tech companies scaling back remote work, those who moved here for cheaper housing are now second-guessing whether the daily grind is worth the supposed savings. Local costs are piling up too. Sacramento County has some of the steepest property taxes in the state, and homeowners report water and utility bills climbing higher each year. Add in insurance premiums, which have crept up due to wildfire risks in surrounding counties, and Sacramento's affordability advantage starts to look thin. And then there's quality of life concerns. Residents talk openly about rising crime, schools struggling to keep up, and infrastructure that hasn't caught up with the population boom. Imagine moving here in 2021 with dreams of a quiet suburban upgrade, only to find yourself paying nearly the same monthly bills you fled from with less job security and longer commutes. So here's a question for you. If Sacramento was supposed to be the affordable alternative, but now looks nearly as costly and unstable as the coastal markets, does it still make sense? Or has the capital city lost its edge in California's housing shuffle? Share your thoughts below, because Sacramento's trajectory could decide the fate of California's entire inland housing market. At number 2, we arrive in San Bernardino, a city that has long been seen as both an opportunity and a warning. Located in the Inland Empire, San Bernardino was once considered the affordable escape hatch for families priced out of Los Angeles. You could get more space, more house, and a quieter lifestyle, at least on the surface. But in 2025, San Bernardino is experiencing one of the steepest declines in California real estate. Home values that once crept above $400,000 are now sinking toward the $260,000 mark in many neighborhoods. That's a near 40% haircut, and the pain is visible street by street. Part of the struggle is tied to perception. San Bernardino has wrestled with high foreclosure rates before, and those scars haven't healed. When buyers search online and see a flood of bank-owned properties, it sends a chilling signal. Why buy here if everyone else is leaving? It becomes a self-fulfilling cycle. Jobs are another hurdle. While logistics and warehousing provide some stability, wages often lag behind the cost of living. As inflation pushes up everyday expenses, families here are caught in a squeeze. Lower property values, but not enough income relief to make ownership feel secure. Then there's the social fabric. Many locals talk about neighborhoods where houses sit half empty, rental properties flip between tenants, and crime worries scare off new buyers. Imagine moving into what you thought was a bargain home, only to find plywood on windows down the block and for sale signs collecting dust in the Sunday. San Bernardino also faces infrastructure challenges. Aging roads, struggling schools, and stretched public services mean the city isn't competing well with nearby Riverside or Ontario, where communities feel more stable. Investors notice that difference, and so do families choosing where to plant roots. So let me ask you, would you be willing to buy cheap if it meant moving into a market that feels stuck in reverse? Or is San Bernardino proof that sometimes the lowest price comes with the highest risk? Comment below, because this city may be the clearest sign yet of how fragile California's housing foundation has become. At the very top of our list is San Francisco, the city once hailed as the crown jewel of California real estate. For decades, owning property here wasn't just about having a home. It was about joining an exclusive club. Condos in the Mission, Victorians in Noe Valley, glass towers downtown, everything sold for eye-watering prices, and buyers still lined up. But in 2025, San Francisco's housing market looks very different. Median home values that once soared well above $1.5 million have slipped significantly, with certain neighborhoods seeing declines of 25 to 35%. For a city where the word discount used to mean shaving a few thousand off a bidding war, those are seismic drops. Remote work has been both a blessing and a curse. In 2020, it boosted demand for bigger spaces as tech workers sought home offices. But now, as companies drag employees back to physical offices, the shine has worn off. Downtown condos, once in high demand, are struggling to attract buyers, while office vacancies spill into the housing sector. Empty skyscrapers don't just hurt businesses, they cast a shadow over residential demand. Then there's the cost of living. Property taxes remain sky high, utility bills keep climbing, and insurance rates reflect the city's density and earthquake risk. Add in the reality of rising HOA fees in those shiny high rises, and many buyers are realizing the true cost of owning in San Francisco goes far beyond the listing price. Quality of life concerns have also dented the city's appeal. Headlines about crime, shuttered retail shops, and visible homelessness downtown have spread nationally, making potential buyers second-guess whether the prestige is worth the hassle. Imagine paying over $1 million for a condo only to find your building's retail space boarded up and your street dotted with for lease signs. Yet San Francisco remains a paradox. Its culture, its history, its innovation, they're still world-class. But the housing market is no longer bulletproof, and 2025 has proven it. So here's the big question. Is San Francisco's downturn a once-in-a-lifetime buying opportunity, or the clearest sign that California's housing bubble has finally burst? Tell me what you think, because San Francisco's fate could shape the state's future. So there you have it, 10 California cities where home prices are losing value faster than anyone expected in 2025. From waterfront towns like Ventura and Oxnard, to inland hubs like Fresno and Bakersfield, to icons like San Francisco, the pattern is unmistakable. The dream of California real estate has hit a rough patch. But what does it all mean for you? If you're a homeowner in one of these markets, it can feel like watching sand slip through your fingers. Equity that once looked untouchable is shrinking, and the hidden costs, insurance, taxes, HOA fees, utilities don't let up even when your home's value drops. It's a painful reality, and it forces tough decisions about whether to stay put, refinance, or even walk away. If you're a buyer, the story is more complicated. Yes, prices are down, and on paper that creates opportunity. But opportunity only matters if the fundamentals are solid. A cheap house in a city losing jobs, struggling with infrastructure, or bleeding population isn't really cheap, it's a gamble. Ask yourself, are you buying value or just buying into someone else's exit strategy? California has always been a land of extremes. Booms feel bigger here and busts cut deeper. This crash doesn't mean every neighborhood will collapse, but it does remind us that no market is invincible. Even the Golden State has cracks in its foundation. The bigger question is what comes next. Will California's housing market stabilize as interest rates cool and wages catch up? Or are we looking at a longer reset where affordability finally pushes more people and more money out of the state entirely? I'd love to hear your thoughts. Would you still buy in California today? Do you think these price drops are temporary or the start of a bigger correction? Drop your answer in the comments, because the conversation isn't just about houses, it's about the future of California itself. And if you found this video helpful, make sure to like, subscribe, and share it with someone who's thinking about buying or selling. Staying informed could save them and maybe you from a very costly mistake.